Though there are countless different mortgage fraud schemes, there are only two types of mortgage fraud: fraud for housing and fraud for profit. Fraud for housing is usually committed by a potential homebuyer in order to purchase a home for his or her own use. Typically, fraud for property involves a borrower who is trying to purchase a home and cannot legitimately qualify for a loan. The borrower misrepresents information on the application and generally will alter other documents related to his or her income, assets, or employment. Borrowers who commit fraud for property often do not recognize that they are doing anything wrong, especially if they are being assisted in the fraud by an industry insider such as their MLO. Fraud for housing represents illegal actions often initiated by the borrower. The simple motive behind this fraud is to acquire and maintain ownership of a house under false pretenses. This type of fraud is typified by a borrower who makes misrepresentations regarding his income or employment history to qualify for a loan. The defrauding of mortgage lenders should not be compared to predatory lending practices, which primarily affect borrowers. Predatory lending typically affects senior citizens, lower income, and challenged credit borrowers. Predatory lending forces borrowers to pay exorbitant loan origination and settlement fees, subprime or higher interest rates, and in some cases, unreasonable service fees. These practices often result in the borrower defaulting on his mortgage payment and undergoing foreclosure or forced refinancing. Although there are many mortgage fraud schemes, the FBI is focusing its efforts on those perpetrated by industry insiders. The FBI is engaged with the mortgage industry primarily in identifying fraud trends and educating the public. Some of the current rising mortgage fraud trends include equity skimming, property flipping, and mortgage-related identity theft. Equity skimming is a tried and true method of committing mortgage fraud. Today's common equity skimming schemes involve the use of corporate shell companies, corporate identity theft, and the use or threat of bankruptcy or foreclosure to dupe homeowners and investors. Property flipping is nothing new. However, once again, law enforcement is faced with an educated criminal element that is using identity theft, straw borrowers, and shell companies, along with industry insiders, to conceal their methods and override lender controls. Property flipping is best described as purchasing properties and artificially inflating their value through false appraisals. The artificially valued properties are then repurchased several times for a higher price by associates of the flipper. After 3 or 4 sham sales, the properties are foreclosed on by victim lenders. With most fraud for housing, the borrowers intend to make all payments, and the participants in the scheme are rarely paid for their participation. The participants usually involved in fraud for housing schemes are the borrower and the borrower's family members. Some of the most common fraud for housing schemes include misrepresented income, which includes fake or forged employment verifications, or fake or forged tax returns, pay stubs, or W-2s. Also included are misrepresented assets, such as fake or forged bank statements. Also, undisclosed obligations, such as second mortgages. Other common fraud for housing schemes include loans presented as gift funds and occupancy fraud, as well as misrepresenting their intent to occupy. Now that you have a better understanding of fraud for housing, let's switch our focus to fraud for profit. Fraud for profit is sometimes referred to as industry insider fraud, and the motive is to revolve equity, falsely inflate the value of the property, or issue loans based on fictitious properties. Based on existing investigations and mortgage fraud reporting, 80% of all reported fraud losses involve collaboration or collusion by industry insiders. Fraud for profit occurs when a person or a group of people abuse the mortgage lending system for personal monetary gain. These individuals are often professionals that know how to exploit the complex finance system at the expense of lenders, taxpayers, consumers, and communities. The motivation behind fraud for profit is clearly money. Fraud for profit is often committed with the complicity of industry insiders such as mortgage brokers, real estate agents, property appraisers, and settlement agents such as attorneys and title examiners. Over the next few pages, we will focus on a few more facts about fraud for profit, as well as common fraud participants.